We dividend investors can't resist a good deal, and right now there are so many different ones to choose from, but in today's video we'll be honing in on 3 stocks that seem like particularly great pickups for your portfolio as we fly into July. But real quick before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I want to hear what you think is looking like a good buy right now. And also guys, if you want to keep track of how all my stock picks in this video series are performing, I've put together a free public scoreboard where you can see everything all in one place. This spreadsheet tracks how all of my stock picks have done since mentioning them in these videos. And if you want access to this spreadsheet, just click the link in the description of the video or in the pinned comment. Now, you might not be familiar with this first company unless you are deep in the weeds in the commercial trucking industry, which I don't know, maybe you are. This one is very under the radar, and I first heard about it from watching my guys over on the Dividend at Diplomats channel. But with that said, you've most definitely seen Paccar's products out on the road. This is the company behind Kenworth, Peterbilt, and DAF trucks, which are 3 of the most respected names in the commercial trucking industry. These are premium vehicles known for their quality, durability, and cutting-edge technology, and they've built a strong and loyal customer base over the years. This company's been around for a long time. Now, what makes Paccar stand out to me isn't necessarily the trucks themselves, which are very cool, and it's not even the fact that many in the industry aspire to own these trucks. It's more so the business model behind this company that I think is so cool. Every truck that Paccar sells opens the door to 2 more recurring revenue streams, one from replacement parts and another from financing. So when someone buys a Peterbilt, Paccar doesn't just make money from the sale of that truck, there's more to it. They also continue to generate income if the customer finances the purchase of that truck, and they also continue to make money down the road as the customer needs to order new parts for it. Even though these trucks are far from being cheap, they're actually considered a premium product, Paccar has created a kind of razor and blades business model here, and that model is applied to an industry that's absolutely essential to the global economy. Here in the US, trucks move nearly 72% of all freight. That means a huge majority of the supply chain depends on vehicles like the one Paccar produces, and it's a relatively concentrated industry. There aren't a whole lot of companies that make these big trucks. Still, with all of that said, despite how strong and essential the underlying business is, the stock has been performing pretty poorly lately. Taking a look at the share price performance over here on Snapstock, we can see in the last month, Paccar is down 3.8%, so a pretty decent drop here just in the last 30 days. But if we zoom out looking at the year-to-date performance, the stock is really coming down. It's down about 12% so far in 2025, and zooming out once more over the last 365 days, it's also down double digits. It's down 10.25%. With that though, despite this drop, we can see that we're getting a pretty above average company. Looking at the Snap score, this is coming in at 6.7 out of 10. And from top to bottom, for the most part, we're getting some really solid scores here. Growth is perfect, a 10 out of 10, but profitability is a bit on the lower end with a 4 out of 10, which is probably no surprise considering the nature of this business. They manufacture heavy equipment, and that's definitely a capital-intensive business. Along with that, debt's a 4 out of 10, but the debt situation's actually not that bad. We'll take a look at it, and then things are looking pretty good in the dividends and buyback section, and looking at the capital efficiency here, both 7 out of 10. So overall, looking pretty strong, and if we scroll down looking at the growth here, we can see that for the most part, Paccar has been a pretty growthy company over the last decade. Just glancing at the charts here, everything for the most part is trending up and to the right, and these compound annual growth rates are looking really good. The revenue growth has been about 16% on average over the last 5 years, really solid revenue growth since 2020. The earnings per share growth has also been very impressive, growing about twice as fast as revenue with a 33.4% 5-year growth rate, and the free cash flow per share is also looking really strong, growing at a rate of about 21% on average. With that, scrolling down, looking at the debt situation, the reason that the debt score was so low, a 4 out of 10, is because the interest coverage for 2024 is listed as 0, which isn't the case. The data here just hasn't loaded yet, but everything else is looking pretty good. I mean, the debt for the most part over the last decade has been pretty steady. Looks like it has trended up a little bit these last couple of years, but still, the net debt to free cash flow is in great shape, and in 2024 it was only about a 3, which is well below the threshold of what I'd like to see for a company like this. Typically, my rule of thumb is to look for a net debt to free cash flow of about 5 or below, and really, generally speaking, the lower the better, but anything 5 or below I think is kosher. But then getting into the good stuff, guys, looking at the dividend stats, this is actually a decently high yielding stock. Right now, you can lock in about a 4.2% dividend yield. And then along with that, it looks like they've done a great job of growing the dividend over the last decade. Admittedly, this dividend per share chart is a bit all over the place. We do see some choppiness here, a little bit of ups and downs, and part of that is because they did cut the dividend here in 2020, which is definitely a bummer. But the other part of that, we can see that they also reduced the dividend here between 2023 and 2024, but it actually wasn't a dividend cut. Every single year, Paccar pays out these huge special dividends. And as we can see from this chart here, these special dividends tend to be quite hefty. So that's also why we're seeing some choppiness here in the dividend per share chart. So overall, I think there's a lot to like about this company. I actually just recently added it to my watch list as well. So I'm going to be spending a bit more time with this one moving forward, and I'm very excited to. Seems like there's a lot of good stuff going on, and I think at today's prices, Paccar is definitely a good one to consider. Now, the second company you should definitely be familiar with. Ross is the largest off-price apparel and home goods retailer in the United States, operating under the Ross Dress for Less and DD's discount stores. They focus on selling brand name items at big discounts, which usually end up being anywhere from like 20 to 60% off normal retail prices. And while the stores themselves really aren't anything special, that's kind of the whole point. It's all about value at Ross. That's why you shop there. And part of what makes Ross stand out and part of what makes people want to shop there is the thrill of the hunt. You go there not knowing exactly what you'll find, but you know it's probably going to be a good deal, and that's what makes for a fun experience, especially among shoppers who are buying on a budget. And the thing about people in general that will never change, and this is why Ross is so successful, is that people will always want to buy things as cheap as possible. We always love a good discount. And speaking of good discounts, right now you can buy Ross right off the clearance rack. Just in the last 30 days, the stock is down 11.4%. So a very big drop for these guys. And year to date, that's going to leave the stock down 17%. So an even bigger drop so far this year. Now, if we zoom out once more over the last 365 days, it's still down double digits, down about 13.5%. And with this one, we're also getting a very high quality company with a snap score of 6.9. Now, for the most part, these scores are pretty impressive. Growth is only a 5 out of 10, but it's actually not as bad as it seems. We'll get into that in just a moment. And profitability is also very low as well, with a 3 out of 10, which I think makes sense though, because Ross is competing on value. That's their edge. And so selling for lower prices is obviously going to lower their margins. That's something that's just baked into their business model. And scrolling down, looking at the growth metrics, like I said, the 5 out of 10 is really not as bad as it seems. I actually think it deserves a higher score. And what's causing that 5 out of 10 score is 2021. It looks like we saw a dip in sales. We saw a dip in earnings per share. And I think that's just throwing things off. I mean, this aside, we can see that for the most part, the growth has been very consistent from top to bottom. It looks like there's been a couple of interesting years here in the free cash flow per share, 2022 and 2023, but they definitely brought it back up here in 2024. So overall, I think that's looking pretty good. And if we scroll down looking at the debt situation, it has been steady. The debt's been a little bit up and down, but it's hovered within this range, at least for the last handful of years. And the net debt to free cash flow is really nothing. It's actually less than 1. It's only 0.5. So I'm really not worried about the debt situation. And then scrolling down, looking at the dividend stats. With Ross, we're getting a much lower starting yield than with the last company. Right now, you can lock in a 1.15% yield, but I do believe this company more than makes up for that with the dividend growth rate right here, which as we can see has been very consistent, very aggressive. There was a blip here in 2020. They did cut the dividend this one year, but moving into 2021, it's almost like they didn't even skip a beat because they raised that dividend right back up and have grown it every single year since. And then scrolling down, looking at the payout ratios, the dividend looks to be very well covered and the payout ratios have been very consistent. At least the earnings payout ratio has. It looks like it's hovered at around the 24-25% range, mid-20s we'll call it, for pretty much over the last decade. And then with that, the free cash flow payout ratio, it's had its ups and downs, but it looks like it peaked at about 45% back in 2023. And remember, these 2 years right here were the years that we saw that slight reduction in free cash flow. But even then, if that's the worst that the payout ratio has gotten, this is still very well covered. It doesn't look like Ross is at any risk of cutting their dividend anytime soon. So with that said, if you're looking for another great dividend growth stock, I think Ross is one that you want to put on your watch list. We'll see what the share price does from here, but I don't think it's looking too shabby right now. If you had a cell phone in the early 2000s, you definitely know Motorola. This was the company that made the iconic Razr, which interestingly is actually making a comeback. And while most people still associate Motorola with that era and with their cell phones, the company actually looks a lot different today than it did back then. Back in 2011, Motorola actually split into two different businesses. The phone side, which is what most people remember, was sold off, passed around, and is now owned by Lenovo. And then the other side became Motorola Solutions, which is the company that we're talking about today. And honestly, I think this is the more interesting business of the two. Today, Motorola Solutions is a niche communications company that serves mission-critical industries. Think fire departments, police departments, EMTs, and other first responders. They make essential tools like two-way radios, body cameras, and command center software that helps these emergency teams communicate clearly, securely, and most importantly, without disruption when it matters most. Like I said, this is a very niche business, but it's also a very sticky business. Their customers are likely not going to just up and change their entire surveillance system, their entire communication system on a whim, especially if they're already ingrained in Motorola's ecosystem, and that ecosystem is growing over time. The company is also starting to see growth from newer areas like video surveillance and their command center software, both of which are solid recurring revenue streams. With all of that said though, like the last two companies, Motorola's share price has seen a decent hit. Just in the last month, we can see it's down about 4%, 3.9%. If we zoom out looking at the year-to-date performance, so far in 2025, the stock is down double digits, it's down almost 11%. With that though, here with Motorola, we're actually getting the highest snap score of the day at exactly 7 out of 10. Not too shabby, and we're getting some very solid scores from top to bottom. Looks like growth, profitability, and dividends and buybacks are all coming in at 7 out of 10. Capital efficiency is 6 out of 10, and debt's getting the highest score with an 8 out of 10. So that all looks really good. And scrolling down, getting into the growth, I think this chart right here looks the best out of all three of the companies that we've looked at so far today. While the growth charts on all three companies were more or less up and to the right, this one to me looks the most consistent. And looking at the compound annual growth rates, revenue's coming in strong at almost 10% on average over the last 5 years. Earnings per share is even higher at about 14.25%, and free cash flow per share is also looking at really good at 11.7%. So this is a very solid and steady grower. And then scrolling down, I think the debt situation's looking great. We're getting a solid net debt to free cash flow of only 2.1, so that's definitely within our threshold. And the interest coverage is also very high at 9.1. So I like both of these stats right here. And then scrolling down, looking at the dividend stats, kind of like with Ross a moment ago, this one's also going to be a lower yielding stock. Looks like the yield is coming in right at about 1%. So the lowest yield of the day, but still this has been a very consistent and solid dividend grower with a 5-year CAGR of 11.25%, a 10-year growth rate that's even higher by about 1%. Along with that, if we scroll down looking at the payout ratios, the dividend looks to be very well covered. Payout ratio has been very consistent throughout the years, and it looks like in the most recent year in 2024, the earnings payout ratio is only about 41.5%, and it's even lower actually looking at the free cash flow payout ratio. In 2024 is only 31.5%. So once again, this dividend's very well covered, plenty of room to continue paying and growing this thing. With that said, I think Motorola Solutions is looking like another very solid contender if you're in the market for a great dividend growth stock. In fact, I think the same is true for all three of these companies that we've looked at today. With that though, these three aren't the only ones. There are still quite a handful of other companies that I think you need to keep your eye on. The first one, guys, is A.O. Smith, and we talked about this in last month's video, but since then it's down even more. It's down another 5% just in the last month, which is going to leave the stock down. It looks like 5.5% year to date, so definitely keep your eye on this one. And then moving on, Booz Allen Hamilton, BAH, is another one to watch. I think we talked about this in last month's video. Maybe we briefly mentioned it, I don't remember, but nonetheless, the stock is down 4.8% in the last 30 days, so a decent drop there. But if we look at the year-to-date performance, this one's really jumped off a cliff. It is down 23.3% just here in 2025. At any rate, guys, next up we have Dick's Sporting Goods, which is actually up a little bit in the last month. The stock has seen a gain of about 2.4%, but if we look at the year-to-date performance, it's still down a whole heck of a lot. It is down 23.3% for the year. So yeah, I think this is still a good one to keep an eye on. Moving on, I think General Mills is looking pretty good. They've also seen a slight gain in the last 30 days. They're basically break even though. Who are we kidding? Looking at the year-to-date performance though, General Mills is down 14.6%. So still a pretty big drop here in 2025, and they're actually sitting right there at their 52-week low. Moving on, on, guys, I think Home Depot is a good one to keep an eye on too. The stock is down 2.7% in the last month, and year to date, the Home Depot is down 8.3%. So a pretty decent drop for these guys. And you can't mention the Home Depot without also mentioning Lowe's. I do think this is also one to watch. It's getting pretty interesting, guys. It had a really nice day today, but prior to this, it was sitting closer to like the $210 per share range. Nonetheless, it's down 2% in the last month, which is going to leave the stock down 11.2% year to date. So yeah, I think both of those ones are good ones to keep an eye on, both Lowe's and Home Depot. And then next up, we've got Old Dominion Freight Line. I really like this company. I've talked about this one quite a few different times this year, but in the last month, the stock is down 1.65%, and year to date, it's still down 10.6%. So I still think this is one to watch. The share price is still looking pretty decent, and overall, it's a very high quality company, as we can see, with the snap score coming in at about 8 out of 10. Anyway, moving on, I think Pool Corporation, which is another company we've talked about at least a couple of times this year, is a good one to watch. The stock is down 2.5% in the last month, but year to date, it's down a whole lot more. It's down 12.5%. But anyway, this next one, as a lot of you guys know, is the most recent addition to my portfolio. I've been buying this stock every single week. I actually bought some right before I started recording this video too. But I think Zoetis is still looking like a really interesting company. In the last month, it's down 5.4%. And if we look at the year-to-date performance, it's not down a whole lot. It's only down 3%, but this is a very high-quality company with a snap score of about 8.5. Look at those scores right there, guys. Yeah, I think Zoetis is definitely one to watch, and for the time being, I'm going to continue adding more shares. Anyway, those are all of the stocks that I think are good ones to watch right now. If you want to hear about a handful of other companies that I'm most definitely staying away from and suggest you do the same, then check out this next video right over here. In this one, you'll learn about 3 dividend stocks that are showing some pretty big red flags that lead me to believe they could be next to cut their dividends, which is such a bummer. But anyway, click right over here to check those out, and I'll see you in the next one.